When the topic of stop-loss orders comes up, most investors react with either overconfidence or quiet discomfort. Some treat stop-losses as a mechanical safety net that guarantees protection, believing that once a stop is placed, risk has been neutralized. Others avoid them entirely convinced that stops are designed to kick them out of good positions just before prices recover. Both reactions miss the deeper truth. Stop-loss orders are not about prediction, and they are not about control. They are about admitting a hard reality that every serious investor must face. Sooner or later, losses are unavoidable, but catastrophic losses are optional. At its simplest, a stop-loss order is an instruction to sell an asset once it reaches a predetermined price. The intention is straightforward. If a position moves against you beyond a certain point, you exit automatically, limiting further damage. On paper, this looks like common sense. In practice, it touches the most sensitive nerve in investing: the conflict between discipline and hope. Hope is the silent killer of capital. It convinces investors to wait just a little longer, to give a losing position more time, to believe that the market must eventually recognize what they already believe to be true. Stop-loss orders exist to remove hope from decisions that should never depend on it. The real role of a stop-loss is not to improve returns, but to preserve the ability to continue playing the game. Capital is finite. Once it is severely damaged, compounding becomes mathematically and psychologically harder. A 50% loss requires a 100% gain just to break even, and during that recovery attempt, fear tends to replace rational judgment. Stop-loss orders act as circuit breakers. They accept small controlled losses in exchange for protection against the kind of drawdowns that permanently alter behavior and decision-making. One reason stop-losses are misunderstood is that they are often discussed in isolation, as if they are a standalone strategy. They are not. A stop-loss only makes sense in relation to position size volatility, time horizon, and the reason the investment was made in the first place. A tight stop on a highly volatile asset is almost guaranteed to be triggered, not because the thesis is wrong, but because normal price movement is being mistaken for danger. Conversely, a stop placed so far away that it is never realistically hit offers little real protection. The effectiveness of a stop-loss lies in calibration, not in the mere act of placing one. Another important distinction is the difference between trading and investing. Short-term traders rely heavily on stop-loss orders because their edge depends on reacting quickly to price information. Long-term investors, however, are often dealing with businesses' themes or asset classes meant to be held through cycles. For them, a stop-loss based purely on price can conflict with a fundamentally driven thesis. This is where many investors make a quiet but costly mistake. They adopt trading tools without adapting them to an investing mindset. The result is being stopped out repeatedly, not because the long-term view was wrong, but because the tool was mismatched to the objective. That said, long-term investing does not mean unlimited tolerance for loss. There is a difference between volatility and damage. Volatility is noise. Damage is a break in the underlying thesis. Stop-loss orders can still play a role for investors when they are tied to that distinction. A stop can represent the point at which new information invalidates the original reason for owning the asset. In this sense, the stop is not just a price level. It is a line of intellectual honesty. It defines in advance where you admit you were wrong before emotions have a chance to renegotiate the rules. One of the quiet benefits of stop-loss orders is psychological relief. Knowing that downside is capped allows investors to size positions more rationally and to stay calm when markets move violently. Fear tends to escalate when losses feel open-ended. A predefined exit transforms uncertainty into a known quantity. This does not eliminate stress, but it keeps stress within tolerable boundaries. Over time, this emotional stability can matter more than any single gain or loss because it supports consistency, and consistency is what allows skill and compounding to show their effect. However, stop-loss orders are not without cost. Markets are not smooth. Prices overshoot, liquidity dries up, and short-term dislocations occur even in healthy assets. Stop-losses can be triggered by temporary panic only for prices to rebound shortly after. This experience is emotionally painful and often leads investors to abandon stops entirely. The mistake here is not the existence of the stop, but the lack of a broader framework. A stop loss should never be judged by a single outcome. It should be evaluated across many decisions where its role is to reduce tail risk, not to optimize every trade. There is also a technical reality that must be acknowledged. Stop-loss orders do not guarantee execution at the exact price specified, especially in fast-moving or illiquid markets. Gaps can occur. Slippage happens. This is another reason stop-losses should be seen as risk management tools, not insurance contracts. They improve odds. They do not eliminate danger. Believing otherwise creates false confidence, which is itself a form of risk. Ultimately, the conversation about stop-loss orders is a conversation about self-trust. Can you define your risk before entering a position? And can you respect that definition when the market challenges you any investors cannot, which is why automatic stops exist? They are not a sign of weakness. They are an acknowledgement of human limitation. The market does not reward stubbornness. It rewards those who survive long enough to let good decisions compound. As we go deeper into this subject, the real question is not whether stop-loss orders are good or bad, but when they protect capital effectively, and when they actually undermine long-term performance. Because understanding that boundary determines whether stops become a foundation of disciplined risk management or a source of constant frustration and second-guessing. And this is exactly where we need to go next, by examining when stop-loss orders truly protect capital and when they quietly sabotage performance, because this distinction determines whether they function as tools of discipline or sources of constant regret. Stop-loss orders protect capital when they are aligned with position sizing volatility and the original investment thesis. A stop that reflects the normal price behavior of an asset, rather than arbitrary percentages, gives the position room to breathe while still defining a clear point of failure. In these cases, the stop is not an emotional reaction. It is a premeditated admission of uncertainty placed before fear or ego has a chance to intervene. Stop losses become destructive when they are used as emotional crutches. Investors who place stops simply to feel safe often position them too close to the market, guaranteeing frequent exits, driven by noise rather than information. This creates a cycle of being stopped out re-entering and paying repeated transaction costs, while missing the very moves the original thesis anticipated. Over time, this pattern erodes confidence and returns not because the idea was wrong, but because execution lacked coherence. Another critical factor is time horizon. Short-term strategies require mechanical discipline, and stop-loss orders are essential there. Long-term strategies require intellectual discipline, and automatic stops must be used more carefully. For long-term investors, the more effective stop is often a thesis-based rule if specific conditions change exit. Price alone is a blunt signal. Using it without context risks confusing volatility with failure. The danger is not loss. It is abandoning a sound process due to impatience. Market structure also matters. In highly liquid markets, stops function relatively smoothly. In thin or stressed markets, they can trigger cascading sell-offs, executing at prices far worse than expected. Investors who rely on stops in such environments without understanding liquidity are exposed to a false sense of control. Risk management is not about eliminating uncertainty. It is about respecting it. The most disciplined investors use stop losses sparingly but deliberately. They size positions so that even a stop-out is survivable. They accept losses quickly without narrative or blame. They review outcomes in aggregate, not trade by trade. This is how stop-loss orders fulfill their true purpose, protecting the investor from ruin, not from discomfort. In the end, stop-loss orders are a mirror. They reveal how an investor relates to being wrong. Used well, they enforce humility and preserve capital for future opportunities. Used poorly, they amplify fear and turn normal market behavior into a series of self-inflicted wounds. The difference lies not in the order itself, but in the clarity, patience, and self-awareness of the person placing it. If this discussion helped clarify how stop-loss orders fit into disciplined risk management, consider subscribing to stay with these deeper conversations about protecting capital before chasing returns, and leave a comment sharing how you currently manage losses. Because the way losses are handled often matters more than how gains are pursued.